Hello guys and welcome back to Equi Edge Research, where we simplify your investments and decode stock market psychologies. So basically guys, the topic on which that we are going to discuss today is capitalism. Basically guys, if we try to understand capitalism from past, the definition of capitalism was owning things. Basically you might own big factories, big oil rigs, or you might own a big industrial infrastructure, etc. Basically these assets, they were measurable, visible and heavy. But now if we try to understand and screen the stocks in the Indian markets, or if we try to understand the companies in the Indian markets, most of the companies, they don't have big steel plants, they don't have oil rigs, or they don't have big warehouses to store their raw materials. Some of them in fact don't manufacture. So as a research analyst, something must come into your mind, that what are those strong factors that are giving these companies a massive growth even when they are not doing high capex on tangible assets, but they are strongly moving towards intangibles. Now these factors, they might have very good idea, they might have a very strong code base, they might have very strong brand value or the customer loyalty towards a product, or a strong goodwill. Guys, if we try to account all of these factors, we can account it into a single concept known as intangibles. So basically when we try to account all of these assets in books or in balance sheets, we try to account them with the concept of intangible assets. So basically guys, if we try to talk about from 2004 to 2014, the classical capitalism was described as owning things. Like we talked about owning factories or oil rigs, etc. But we have seen a radical shift or a value migration in capitalism from 2014, since 2014 to 2024. This is the time when the value has migrated towards intangibles or investments in intangibles. Now intangibles are the factors that are responsible for tangible wealth creations. And here's the topic we need to understand as capitalism without capital. Guys, without wasting your further time, let's move, let's have a research, let's talk further on capitalism without capital. So guys, in the first part, we are going to understand things based on an analogy. So guys, have you ever observed or have you ever played the game of dominoes, and you have observed the last domino falling, and you tend to ask, why did this last domino fall? Well, this cannot be answered without going into the past and see the first domino which was energized and hit, which eventually hit the next, eventually the next, and with the course of time it tends or helps to fall the last domino. Similarly happens in the real life. When we want to understand something or a concept or a value migration today, we need to understand it by going into the past and connecting the dots. Basically guys, if we try to understand by taking two huge data sets, let's suppose taking it from 2004 to 2014 and from 2014 to 2024, and it includes the top wealth creators or top 10 wealth creators. If we try to observe from 2004 to 2014 the companies from the top 10 creators, almost 50% of wealth creators were based from the companies which expected or needed a huge capex on tangible assets. प्लांट हो सकता है, मशीनरी हो सकती है, मतलब हैवी एसेट्स हो सकते हैं, या फिर लेबर हो सकता है, एक्सेट्रा, जो हैवी फिक्स एसेट्स. Whereas when we try to observe the companies from the tenure of 2014 to 2024, these companies which almost 70% of companies which were the huge wealth creators, they were doing asset light businesses. They didn't expect a huge capex on tangible assets, rather they were inclined to intangibles. Now let's talk about the top 2 or 3 companies in the first tenure of 4 to 14. We take examples of ITC and ONGC. Basically both of them were best at their core competencies, ITC selling cigarettes and ONGC at refining and digging out oil. But if we try to understand, in both of the situations, the market valued the same stocks from 4 to 14, the best wealth creators. But when we see the list of wealth creators in the next tenure, they were not seen in the list. The market gave these activities the best valuations from 4 to 14, where the traditional capitalism was emerged, or the traditional capitalism was in trend. But markets started devaluing these activities which were finite at giving growth, finite at expansion, finite at creating synergies, finite at these kind of activities where the expansion is finite. Whereas from 2014 almost, it started to move towards the companies, or the valuations were going good towards the companies which were asset light businesses, which didn't need a lot of capex on tangibles, rather they move to intangibles. Basically we can sniff, or these are the factors where we can sniff the value migration based on from tangibles to intangibles, from brute force or machine loads to the intellectual properties, or acquiring intellectual properties or code bases, or goodwill or the brand values, or marketing, R&D, etc. But in both of the cases we have one exception. You will tell that 2004 से 14 तक और 14 से 24 तक दोनों में Reliance तो दोनों में टॉप में रहा. But as a research analyst, if we try to observe, Reliance in itself has seen lot of differences or lot of changes in its businesses. If we try to understand about the asset allocation of retailer as well as institutional money into the businesses, they have rapidly and understandingly changed the investment cycles. Basically, if we try to understand from 2004 to 2014, Reliance was valued based on its oil refineries and retail, which expected for huge capex on tangibles. Whereas when we see from 2014 to 2024, we can see that Reliance entered in the geo and the telecom sectors, as well as the acquiring companies that also had cloud computing or creating digital infrastructures with artificial intelligence or something related to softwares or asset light businesses. If we talk in the recent times, it is also going to enter in the mutual fund industry with a collaboration of BlackRock. So this movement of from asset heavy businesses to asset light businesses can be very well seen in this. Fun fact guys, in the year 1991, John Sutton from London School of Economics, in his book known as Sunk Costs and Market Structure, and he describes how the application of investing in marketing, R&D, brand building, etc. is going to create or help the company to create polarization of wealth. So basically what he says is, if a company is investing in R&D, marketing or something like this, which accounts for intangibles, it is going to give the companies a competitive advantage which will further help them or eventually help them to dominate their industries. But the theory that we are talking about is not going to apply in the companies or industries where the need of capex to be done is less for intangible assets. Basically we can talk about the sectors like the cement sector or infrastructure or automobiles, etc. These type of investments that are being done in intangible assets are known as endogenous sunk costs. If we say that these ESC costs are absent, or in the absence of these costs, the company need to face some price based competitions. And where do we find these price based competitions? In the industries and in the corporations where there is not a strong need of intangible assets like cement or infrastructure or automobiles that we talked earlier. So guys, in the next video or the next part, we are going to talk about the Brian Arthur. In the year 1996, Harvard Business Review, and it was named as Increasing Returns in the New World of Business. So basically he gave two theories of value migration, from diminishing returns to the increasing returns in the new era of business. So now we are going to understand about these two laws. Now that in first part we talked about the effects of this value migration on big corporate houses, we are also going to talk about the small firms and small corporate houses that are being affected due to the new philosophy or value migration of capitalism without capital. So basically if we try to take data of income tax department about the companies that showed positive non-zero returns, almost 17% of the companies has shown a positive PAT growth preceding 10 years. And the strong point of factor of understanding, or the rare factor, is this 17% companies shows 98% of PAT growth across India or all the Indian institutions. And basically almost all other 83 companies are struggling to come with huge profits or are stagnant in cycle. So basically guys, if we talk about that, the data shows that the upward mobility for the companies from a low profit decile to a high profit decile is really difficult. It's difficult for the small firms and small corporation houses to move to the upper trajectory in the profit decile. Basically, if we talk, however, the scripts that we see, almost all the companies, all the companies that have shown the positive growth are not from top 900 companies. Instead, they are all other 6,000 companies which are below the top 900 companies. Here we see that the value migration has not only affected the big and huge corporate houses, but has also defined and showed how the small corporate houses or the small firms or the all 6,000 or the out of 6,000 who have created growth, how it could make it. They strongly made it in asset light businesses, and all these companies were from small cap and mid cap companies. So guys, in this part we are going to talk about law of diminishing returns. So we are going to understand this with an analogy. Let's suppose you have a small kitchen and you have a burner where you are trying to cook rice. One person is responsible for cooking one plate of rice. Now what you think is you want to increase production. So basically what this law says is, whenever you add up something or a single factor more in the terms of production, in the start the production increases, but as soon as you add that particular factor that is polarized more, the productivity starts decreasing. Let's suppose the rice that we are cooking, we add one more person to it. Now the output is 2 plates. You add one more, it's 2.5. You add one more, it's now 2.7. But when you add the 5th person, the productivity moves to 2.6 plates. Why do you think this happens? क्योंकि अब किचन में ज़्यादा जगह नहीं, हाथ टकरा रहा है. See, due to overcrowding, inefficiencies are going to rise. Space is going to get less because, as we said, the classical capitalism was all about owning things, owning factories. When you try to exceed into a particular factor, let's suppose you are going to exceed labor in a small factory, it is going to get overcrowded, which is going to lead to inefficiencies. Machines are going to get limited, and hence the production gets less. Let's suppose we have a retail shop. You have 2 people, you need 2 people. You kept the 3rd कि help हो जाएगा. But when you added 4th and 5th, now it is difficult for the productivity to be grown. The customers are going to get confused. The space that we have in the retail shop is going to get less, which contracts the space, which makes the customers uncomfortable. At the same time, we are trying to understand the growing return or the increasing returns. This is a type of law where as soon as the production increases, the returns increases. Basically, let us suppose we opened a chocolate factory. Now one machine can create 100 chocolates. We added one more, and now they can create 250 chocolates. We added one more, and now they can create almost 500 chocolates. So basically what we observed is, in this type of business, we saw a growth when we did the investment, or when we added the particular factor. We saw a growth of 0.5, 1.5 or 2x or 3x% of growth. This is what happens in increasing returns, and this is what we have seen as value migrations from diminishing returns to increasing returns. Let us take an example of Zerodha. It's an asset-light business. He created the digital infrastructure once, he needed the cost once, and now he can sell, or he can adapt, or he can bring out the demand with unlimited number of customers with one-time cost. Let's take an example of Byju's or Vedantu. A single video is made with a single particular cost, and crores of students are going to watch it, which is going to let them create revenue. Why do this happen, and how do this happen? This happen because of maybe working efficiencies, that lot of laborers that are working with you. Let's take the example of assembling line of Apple. They are best at what they are doing. The labor is best at assembling the Apple iPhones. If we talk about scaling, we could understand it by Zerodha or Vedantu. If we want to understand it by the case about chocolates, you need a one-time cost, but you can create multiple, or you can scale it at multiple extent. Hence, if we try to conclude both of the laws, पहले वाले लॉ में कोई एक पर्टिकुलर फैक्टर को बढ़ा दिया जाता था, और जैसे जैसे फैक्टर को बढ़ाया जाता था, जैसे उसमें लेबर बढ़ाया, तो प्रोडक्टिविटी पहले बढ़ी, लेकिन टाइम के साथ साथ प्रोडक्टिविटी केम डाउन। जबकि इंक्रीजिंग रिटर्न्स के अंदर जब हम प्रोडक्शन को बढ़ाते हैं तो रिटर्न्स भी बढ़ते हैं। कैसे? जैसे हमने एग्जांपल लिया बाईजूस या वेदांतु का या फिर जीरोदा का, जहाँ पे प्रोडक्ट बनने को वन टाइम कॉस्ट लगता है और फिर वो इन्फिनाइट नंबर ऑफ पीपल को भेजा जाता है। द क्लासिक एग्जांपल फॉर दिस इज द ऑपरेटिंग सिस्टम ऑफ माइक्रोसॉफ्ट, विंडोज 10, विंडोज 12। एक बार इट टेक्स वन टाइम कॉस्ट फॉर इट एंड मल्टीपल पीपल एंड लार्ज नंबर ऑफ पीपल, इनफैक्ट अनकाउंटेबल पीपल आर स्टिल यूजिंग इट एंड स्टिल आर गोइंग टू कंटिन्यू टू यूज इट। This is the nature of increasing returns. That is what we have seen from 14 to 24. The developed economies have seen this almost 10 to 15 years back, or 15 to 20 years past than us, and we are experiencing it now. Thank you.